All right. Okay. So what we're going to do, we're going to start today looking at Yahoo Finance. Okay. So first thing we see is the UAW expands strikes at Ford. And whenever we look at news stories, we say, well, this is either good or bad for the stocks we're watching. And it seems like this is good for Tesla because it's not involved with this at all. Bad for Ford and GM and Stellantis. So looks like Tesla has another competitive advantage, not having unions like UAW who control their costs. So it looks like Tesla is going to be undercutting the prices of making the cars, and until this is resolved, that the three car manufacturers are pretty uninvestable. What we had today was we had we had a low inflation reading. Fed's preferred inflation gauge rises at slowest since 2020. So that was usually whenever we get a really nice story like that on inflation, the stock market pops and it's good. But you see, so yeah, so that was the good news on inflation. But right now we're if we look at our stochastics in our S&P, we're basically right at the bottom. We can't get any closer to a trend line than where we are right now. So either we're going to either bounce from here and go up to a higher high, or we're going to break through here. We've had a lot of the leaders in the stock market already break through their trend line, like Apple and Amazon. So if the S&P breaks through the trend line, then we can't use any of this for market timing anymore. Everything just goes down. So let's hope it doesn't do that. All right. So we have an article here in Yahoo Finance about why the stock market could be primed for a year-end rally. So this is part of the idea of contra investing. Whenever people are extremely pessimistic, that's usually a better time to invest. And what they're saying in this article is whenever you have a down month like September, it's usually followed by a better month. And we have a seasonally weak time of the year. We're coming out of that into the seasonally strongest time of the year. So, but we still have interest rates higher for longer, which could make the stock market go down. And so right now, whenever the Fed said they'd raise rates more, that could definitely break this and make it go down further. The other big thing hanging over the market is they didn't resolve the debt limit today. So we could have a shutdown in the government, and that means the economy should slow down if the government isn't spending money. So that's not good for the stock market. So they usually have something at the last second, so let's hope for that. But if it doesn't happen, that could be another reason why we break out of this trend. All right, that's good to know that. Let's look at our look at our meeting notes for today in our calendar. Okay, so right now we're at the end of September. Okay, we're at the end of September, and usually that's a better time of the year because we have end of quarter window dressing. We have let me see what else we have. We've had, and we're oversold. So if we look at our stochastics charts for the S&P, we're super oversold and we're starting to go up. So that's usually, in a normal market without super bad news like the government shutdown, we would normally bounce. But with the compounded interest rate problem with the Fed and with the shutdown of the government ending, that could bring us out of this. And then who knows, whenever we break through a trend line, we have to look at prior levels of support. And basically it's wherever the trend line hit the baseline before. And if we have support there, we have support here, we have support here. That's an example of if we break through this, we'll probably go through those levels. And then we have to go back years if we go through these support levels. let's hope it doesn't get to that, because this we usually have towards the end of the year, October, November, and December are usually good positive months. So we can see that in our average monthly stock returns. But these aren't golden. They're not perfect. If they were perfect, we'd all be billionaires. But they're not. Sometimes it works, sometimes it doesn't. But there are seasonal factors that like pensions have to put money in at the end of the year. And so there's like a December and November artificial based on what has to be done in the stock market. But 2 years ago, we had a down December, so you can't really count on this stuff. But we did think that September would be bad, and it was. It was probably, it was the best, worst month of the year. Bless you. Okay, so let's look at our meeting notes here. Okay, so we're going to have, we're not done raising interest rates yet. We still have a little bit more of that to go. We're losing more momentum in the stock market. So every week, we're seeing less and less stocks traded above the 200-day moving average. So basically, that's just telling us, and we're starting to have more stocks in the S&P hitting new lows. So that's it. If we break out of this uptrend, then this number will get a lot worse, and then we'll be keeping track of the ones. Another statistic. Because this is more useful whenever we have a bull market and things are going up. Now, what else do we have to say here? We have oil going up. It's been going up steadily, like 20 or 30% in recent times. So that's really bad for inflation, and that could be why the Fed is saying they're going to be raising interest rates a little bit more and holding them, because this is going to cause everything to cost more, and consumers aren't going to have enough money to buy other things if they spend it on gas. The dollar index is unchanged since last week, and gold is pretty much unchanged too. So we don't get anything from that for this week. Today oil's down, so all the oil stocks are down. Fear and greed index. We were at extreme fear earlier in the week. Now we're at fear. This is pretty bad. So usually when people are at extreme fear, that's the time when you would want to start buying or not sell. And whenever it's extreme greed, you want to be selling or not buying. Let me see. Okay, so we're still going up. We have an uptrend in the U.S. dollar. That's bad for multinational stocks, and it's continuing this uptrend. So that's going to be reported on the big tech stocks reports. They're going to say that there's a headwind for U.S. dollar against the other currencies. So that's not good. And the VIX is starting to get. It was at its lowest level of multi-year, like 2 weeks ago. Now it's starting to get elevated as people are more fearful. So, but it's still in this downtrend. So we still have an established downtrend in the VIX. And if we break out of that, then we could get into super fear. And if it gets up to 30, then we're going to be extreme fear in the CNN fear greed index, and everything will be super oversold. And that's the time Warren Buffett comes out and starts looking for things to buy. Right now, we're still at fear. We're not at capitulation. But let's look at some of these topics to see if any of these are coming true that we predicted could cause the next pullback. Chinese real estate, every day there's a different story about Evergrande, their real estate problems over there. So that's one problem. U.S. debt is still, today, they didn't resolve their debt issues and have a budget. So that's causing the stock market to go down. Okay, we don't have any of these in headlines this week. But we do still have overpriced expensive stocks, especially the tech stocks we're following, the big ones. They're still super overpriced, so they can easily correct and make the stock market go down. Until they have a peg ratio of 1, they're still basically overvalued. All right, so higher treasury rates. That's actually happening too. So we're getting higher rates, and the AI stock level is starting to pop. All right, so let's look at some of our stochastics. For almost every sector we're following, almost every sector, you can see we're oversold at the bottom of the channel. So if we're going to keep on going, it'll be going up like this in a line. But if we break through these, we're watching that very carefully. Then that changes the trend, and then we're going to go most likely go down. Okay, look at this. This is the defense. Okay, that's it at the bottom of its range. It's oversold. So every one of these indexes is basically oversold and at the bottom of their trend lines. So we're basically at a decision point right now in the stock market. Yesterday we went down and basically touched the bottom of these trend lines, and we're basically we're waiting for the government debt problem to be clarified and waiting for the interest rates to stop rising for us to really continue where we're going. Okay, so we're going sideways in materials, but you can see we're at the bottom of the trend and oversold. Okay, so every one of those sectors is like that. Okay. We'll go back to individual stocks later. Okay, so right now we have a downtrend in the stocks above the 50-day moving average. So we have zero momentum, and we're losing it on a regular basis, and that's not good. Maybe this could, we look at our calendar, probably November, December, this might start turning around flat to going up again. But let's see what else here. We have, I follow people on Twitter, and they always have great ideas. This guy's, he's a gold person, but he's saying we're right in the middle of the biggest bond market crash in U.S. history. That's pretty big. And I don't even know what a bond market crash is. And so basically that's whenever interest rates rise, like the whenever the interest rates rise, that means the people that are holding bonds and fixed investments at lower coupon rates are going to be under stress. So, for instance, if you have a treasury, the 10-year treasury, and you bought it at 1%, that was 3 years ago, and right now it's trading for 5%. If you had to sell it right now, you would take a huge cut on what it's worth. But if you hold it to maturity, you still get your 1%. That's what this bond market crash is. If there are companies that have to sell their securities early before it matures, then it becomes a liquidity event. And I was looking more what this bond market crash is, and how it happens when bond prices decline rapidly, and that's whenever the yields go up, the bond prices go down. They're opposite. So they can crash when the Federal Reserve increases interest rates. And so what could happen here, I don't know. I'm looking at events like this as a way to get into some fixed investments. And if there's a sell-off, like in the year 2008, there was a sell-off because there were some hedge funds that had to liquidate municipal bonds, and all municipal bonds were basically selling for a 20% discount. And there could be something like that coming around. I don't see it yet, but if that happens, then I'm going to start looking into getting into those because they're more secure than stocks are. And if you can get a bond or a really secure investment, that could be something that comes up like once every 10 or 20 years. But this Peter Schiff said, he said that's happening now. I'm still researching. Does anyone know what a bond market crash is, or what the ramifications of that is?
I never understood bond, or
Okay, well,
people talk about it, but I don't know, maybe Marco might know better.
The ramifications, I would cry. That's the ramifications. If bond market crashes,
how does it work though? Like is
I
the
mean,
interest rate is up, interest rate is up, then bond is doing better. That's how it is,
yeah,
or
yeah.
the other way
Here's
The
around.
market crash. Yeah, go on.
let me give you an example of how I understand it. Hold on for a second. Okay, let's say you buy a bond for 100,000. So basically, whenever you buy a bond, you have the face value is that, and then you have the interest rate. Let's say it's equals 1%, right? That, and you bought that like last year at 2020, and come to this year, you can buy that same coupon and it pays 5%. So the actual value, what you can sell it for, equals something like 70,000. If you sell it before the maturity date, let's say 10-year. This is a 10-year. Okay, 10-year. So it's something like that. I don't know the math right, but the problem with the this situation is if you have a stock like maybe Charles Schwab, and they have all these treasuries that are 1%, then they hold them, and they have to liquidate. They got to take this haircut
Loss.
in the value of loss, and that's why Silicon Valley Bank went under. They had to liquidate all these that they normally would have held for 10 years, and they would have gotten their $100,000 back and 1% interest for every year. But they had to sell early, and they can only sell it for like a fraction of what. And the higher the rates go, if we have this debt problem with the government, no one's going to trust the United States anymore to pay their debt. So we're going to have if we have 11% interest rate, just think of all the stress on these banks holding these 1% interest rates. That's going to be worth like $30,000, because no one's going to want to hold a 1% when you can have 11% return. So this is what you can sell it for. But if you hold this for 10 years, you're going to get your principal back.
So now if you buy a bond at this interest rate, then it's a good thing, right?
Well, you know what? I don't know. It depends. If the interest rates go up to 20%, you're sitting on a liability, and you have to buy a house. You have to liquidate that for a fraction, 1/5 or 1/4.
You don't have to, right? You don't have to.
No. That's part of what we were talking about before, laddering. If you buy, a certain portion of your portfolio now at 5%, and by chance, the government, the United States there's no faith in the United States government. So people have to pay more, like 11%. So you buy a little bit more at 11%. That's called laddering. And if we get up to 20% interest rates, that's what happened in the 80s, then you put a little bit more in. But then you average like 11% total return for your bonds. And so that's called laddering. But when you're forced to sell it, that's why in investing it's so important to know your time frame of investing. Like a lot of these pension funds, they know they need 2% a year for a certain portion of their portfolio. So they can commit to holding it for 10 years if they have a 2% coupon. They know they can hold it, because they have a bunch of people in pensions that are not going to be selling out of their pensions anytime soon. So you have situations where it's not that bad to have your 2% coupon every now and then for a certain portion of your portfolio. But if you have to liquidate, and that's why this Peter Schiff guy is like raising an alarm. He says, a biggest bond market crash in U.S. history, the banks, if people lose faith in the bank, they're going to have to start selling some of these $100,000 coupon at like $30,000, and then they won't be able to cover all the customer deposits. Then they have to have a backstop of the Fed to cover all that. So, but the reason why it's important, I'm not a bond person, but whenever you have stocks that have the same problem, they have to constantly fund their operations. The smaller stocks have a worse time than the larger ones because they have to borrow more to grow. So the higher these interest rates go by the Fed, the more costly it is to ask for more money for continuous operations. So that's how it affects the stock market. But for, the big stocks we're following, the big tech stocks, they're overvalued now, but they're not going to be affected as much by higher interest rates. They probably benefit from it in a way. So anyway, I'll look more into that to see what that really means and see if there's any more indications that there are some opportunities in that. If there was a municipal bond market crash now, I would start putting money, maybe 10% into that, so it's secure, and in different ladders, like 5, 10, 15, 20 years. But it isn't until you keep track of, maybe this is a crash, then you can start looking for those opportunities. I'm always looking for something to be more secure, towards, to get away from. I'm like super heavily invested in stocks, so I need to get some diversification. So this story could be the beginning of a possible way of diversifying into bonds in this kind of situation. I don't know. We'll see.
If you believe the bond market gonna crash, it would be a bad choice to put them in a long-term bond. It would be wise to put them in the short-term bond so you can move them around like cash.
Yeah. Well, the problem with short-term bond is if you have a big portfolio and you're trying to manage holding, a lifetime of, income, that only lasts for like a year or two. Then you got to put it in something else. How do you know next year isn't going to be 1%?
Yeah, but at least you can move your money around this way. If you put it in a long term, how are you going to move your money when the bond market is start crashing?
Yeah, well, that's
why the experts out there say that when in the bad time you should put in a short term bond instead of a long term bond.
Well, I guess it's part of what your needs are. If you're like 80 years old and all you need is 2%.
No, not about the need or the age. It's just about in a time of bond crisis where you're going to put the money. Where you can move them faster.
How do you know if 5% isn't the highest it'll ever go here? So you have to put a little bit in now if you need.
Let's just say tomorrow you want to liquidate because you hear that bond market is crash. Which one sell better, long-term bond or short-term bond?
Short-term.
Definitely short-term.
Yeah. So I guess whenever you hear this,
the ladder one that Greg you mentioned about, I think that's not a bad idea. What I had a question about, don't we have a limit on putting money in bonds? Like 10,000 is the limit. Is that or is it a government bond?
Oh, there's something called iShares. They give it a really large return, like 10% or something, but you can only put 10,000. You can only put 10,000 into that.
10,000, yeah.
Yeah, so that's like for most people that doesn't move the needle, as they say. You can put 10,000 in it, but if you have like $100,000 portfolio or 500,000, that's just a fraction of a percent. So it's but for most other every other bond, you can put as much as you want into it, as long as it's available. Like some municipal bonds, there's only a fixed amount of supply.
Anything that give you tax benefit, there are restrictions. Anything that had no tax benefit, you can put as much as you can.
Yeah. So
they only restrict you because they don't want you to use it as a tax evasion vehicle.
Oh yeah, tax evasion.
But if you don't have any tax benefit, you can put as much as you want.
That's a little bit beyond my area of expertise.
But back to the bond crashing, there is only one in the history of 1994 that the bond market was crashing, and it was crashing because the Fed was raising interest rate. In our times, we are at the end of the interest rate raising rate. The Fed is actually slowing down and not going up that much. So you're not going to see a jump in the Fed rate, couple of percent anytime soon, right? So the fact that Fed rate is slowing down, not stock was slowing down in terms of raising, you wouldn't see any bond crash at all.
Well, let's look at the variables that affect interest rates. Let's say for the U.S. Treasury, and it's the strength of the U.S. economy. So if the U.S. economy starts going into a recession, then interest rates will go down. And then if the economy is powerful and strong, the interest rates go up. That's just without the Fed doing anything. Also, if you had, it's all the prices of the treasuries are all based on the faith in the U.S. government too. So if you have a lack of faith because of this, whatever's going on in Washington today, where they want to have a shutdown in the government or whatever, then people will have to pay more. I mean, the U.S. government will have to pay more for people to borrow their money because it's a higher risk. They might not pay it back. So there's a couple things involved there, but
right. Isn't it true that the limit the government shutdown is addressed every year and kind of is a new threat, right? It happened every year. It's politically influenced, right?
Right.
1994, we don't have that much. For current time, we almost have every year that the government is threatened to shut down. So it becomes mute, to be honest.
Yeah, it seems like it happens more often now than before, but it does happen all the time.
Every year.
Yeah, I guess you have to look at if it does happen, how does that affect stocks? Number one, there's not going to be as much free money to go around. There's not going to be as much stimulus money. There's not going to be free money for corporations to grow and to get out of a COVID situation. They're going to be tighter. So there's going to be less spending on social services. So people with lower income
are negative impact, but I'm questioning the possibility of government shutdown. The possibility is low. If it actually shut down, then yes, all of what you said would be true. But the possibility of shutdown is very low.
Yeah, they usually come up with something at the last second. So I'm thinking it's for investing. It's usually a no-op. It's something you don't. Even if it does happen, it's only going to be for a couple of days before they come up with something because they're not going to get reelected if they're a holdout on the government debt. Because you have to look at how they're going to get reelected in general.
The question would be if the bond market crash, would equity markets can sustain the impact?
That's tough because I don't know anything about bonds, but I do know that whenever there are every crash in the past that we've seen in our lifetime has been revolving around debt problems, borrowing more than you can afford and then getting caught.
So basically, you can run, but you cannot hide. If the bond market crashes, everywhere would be impacted, whether it's bond or equities or not, right?
I'm not sure.
Maybe gold would be the safe haven there, but bond and stock market would equally impacted.
Yeah, I think companies that are leveraged, that borrow money, that have a high levels of debt, and they're more affected, in a situation like that. And companies like banks that have treasuries that are, they have to hold that are losing value, and they might be affected. So there's the stocks that have to borrow money. So those are the ones that are really, really going to be affected by a bond crash. I don't know. I think, gold's going to be pretty consistent. I mean, it didn't perform as well throughout whenever we were printing money for 10 years, you would figure gold would go up with that, but it didn't. It didn't have that one-to-one correlation.
I'm talking about in terms of crisis like bond crash. Not talking about normal scenario.
Yeah, gold will hold its value theoretically. So Jim Cramer recommends, I think, 5% of your money in gold. I don't understand it enough to invest in it, but it makes sense. But it seems like, we have this discussion every time they have this debt limit showdown, and then they resolve it, and then everything's back to normal, and people forget about it. So Warren Buffett, he wouldn't even think about this. He knows the economy is like a freight train, and companies still grow. The economy grows with the population, and the population's growing over time.
I agree with him. Yeah. I don't think we should worry much about government shutdowns and bond market crash.
Right.
The possibility is low.
Yeah, I agree with that. So this, I just wanted to bring this up because, if you can't be scared out of the market. You got to know if this section of investing, these securities, the bonds, have if they have a crash or something, you have to say, well, how does that affect what we're looking at investing in? And if it does, is it a long-term problem or just a short-term? So right now, this doesn't seem to have an effect on a lot of the things we're watching other than banks. So we'll keep our eyes on that, see if there's any indication of stress in these lending or borrowing money. Okay, so that was a good little topic. There was a good earnings report today from Nike. They went up like 10% at the start of the market. Now it's like 5%, and they reduced their inventories. They had a problem with inventories where they corrected in a major way the other day, last couple months ago. And what I did was I thought it was a good idea to review the numbers for Nike. The interesting things about Nike are they're the world's largest manufacturer of apparel and shoes. So they have like a moat, and they have a very strong brand. So their biggest way of growing is direct to market. And in this article, they said direct to consumer sales went up 6%. So whenever we're looking at these Nike earnings reports, we want to look at these direct-to-consumer sales going up. If that keeps going up, that's a good catalyst for that stock to continue to grow at 11% or so. This gross margins, this 42%, that means they're basically making shoes for like $1 and selling for $100. They make a lot for how much they put into making something. It's very similar to Apple's gross margins. So Apple makes a phone for like maybe $100, they sell it for $1,000. So that's what that gross margin is. And let me see. So they beat a lot of things. They were kind of there was a couple of things that they weren't so good at, like maybe revenue wasn't growing as fast. They missed on revenue, it said here, but their earnings were better than expected. But what I did is I thought it'd be good to go through Nike's earnings, and let's look at their chart first. Let me see. Here's Nike's chart. They're in a downtrend right now. They're basically at a level where they were last October. So we were at $90 a share last October. And a lot of times whenever you have a low, this was the absolute low of the stock. Low of the year for the stock right here. So we have support going back a year at the level we're at now at 90. But this company is like a long-term compounding company. They grow like 10% a year. If you buy and hold it, you can probably count on like a 10% earnings growth. I put in what Ingrid Hendershot, this is one of her stocks that she follows and she invests in. So if it's blessed by her, she must know what she's talking about. Then we're paying attention. She said they pay a good dividend and they're repurchasing stock. Okay, that was her thesis of why she wasn't interested in it. And so what I did was I did a little analysis of Nike. Look at their earnings growth going out a couple years. I shouldn't have done that. Okay, there we go. So they're growing around 14% if you average all these out for the next couple years. And their P/E ratio is 24. And so that means the PEG ratio is 1.7. So if we had a stock market crash or something, the chances are their stock will go down to a PEG ratio of 1. So it has a while to go before it's actually trading at its growth rate. If it went down to maybe 60, it would have a PE ratio of 14. And then the PEG ratio would be 1. So that's a fair value of the stock. But it probably won't, because what I do is I put down all the PEs, the PE ratio over time. You can see it basically trades at a 20 PE minimum and a maximum of 30 PE. So it's right around where it has traded in the past. So it's not overvalued or undervalued compared to the PEs that traded for before. A lot of times if you see a stock trade for like a PE at 5 and it's traded for a higher PE in the past, then you would say that it's trading below, what it's traded for in the past, that's multiple. But you can see they're increasing their dividends over the years. And that's really important. It's almost like whenever you increase your dividends every year, if you buy and hold the stock for your whole life, over time that'll keep up with inflation if they keep raising their dividend. And you can see that their revenue over time has been growing, and that's a good sign. It's growing. In general, it's growing around 10%. So it's overvalued right now, but it's good to do this. I looked at Morningstar. They said that it's undervalued. It's undervalued by like 20%. So that's very good that they said that. They said they have a wide moat. They said their Nike brand is their best asset, and they'll have premium pricing, and that brand will be good for at least another 20 years. So that's like a good reason that you can buy and hold this stock, and it'll compound over time. Let's see. It's invested in its direct consumer network while cutting wholesale accounts. Like Foot Locker, they terminated, selling some of their shoes at Foot Locker and a couple of their retailer stores, and they're selling their shoes direct to consumer. So that all improves the margin. That'll help this gross margin go up over time. If they can make this direct to consumer go up, every year, that'll make this gross margin, that's like cutting out the middle. So the more you cut out the middleman, the more profit you make. So you see, that was a good exercise. I think that was fun. Let's see what CFRA says about them. They said the EPS estimate and below the company's 10-year average forward PE multiple of 29. So whenever there's analysts, they say whether it's undervalued or overvalued, they compare it to their 10-year average forward PE multiple. So whenever we looked at these numbers here, these average PE ratios over time, if you add them up and you divide, you'll get like an average PE of 30. And right now PE is 24, so it's PE is trading below what it's traded for in the past. That was a good exercise. Let's see. All right, and so right now this is a good time for Nike to bounce, because it's been at the same level last year at this time, and that it bounced from there. But it's still in a downtrend technically, so we still could start hitting lower highs and lower lows, and let's hope we break out of that, and then we'll resume an uptrend. We don't know. There's an old article that said, forget the sell-off. Tech stocks will have a springboard for growth in 2024. So this Dan Ives, the guy that came up with this, he's like a bull. He's always full of optimism. So it's always nice to look at this on days when the stock market's going down. But he said the themes of next year are going to be artificial intelligence, the cloud, cybersecurity, and digital ad spending rebound. So that involves like most of the stocks we're following, a lot of them anyways, because we know that Facebook, Google, Microsoft, are all involved with all these categories, and but all of them will benefit from hype around that. You see, strong third quarter earnings will be a sneak preview. He says that third quarter earnings, they come out towards the end of the year. That's going to be, if they come out good, then that's a good prediction. Then next year is going to be good. You see. So he's saying that, you know, all this news story we have about the lawsuits against big tech, they've been trying to rein them in for years, but they haven't been successful. So there's multiple attempts to, you know, regulate some of the big tech, but it hasn't worked. So even though you have a news story that says Google is being sued, it doesn't necessarily mean it's going to be successful. Because I think Google's, you know, they have lawyers on their side as well as the other side, so I don't know. So you have to make sure that, I guess you have to read the research to see if any of these could have some ramifications to the company, and if they set rules, then we have to reevaluate at that time whether the stock is going to be affected or not. But so far, they've been trying to do something for all the big tech stocks for a long time, and it hasn't worked. Except for Microsoft, they filed something against Microsoft for Internet Explorer. Just think about it now, how silly that was. But the interesting thing, they had an antitrust lawsuit against Microsoft for bundling Internet Explorer. That focused Microsoft on defending, you know, their Internet Explorer when they could have been doing mobile phones. And that's what Bill Gates said one time. He said he was so distracted by this lawsuit, he didn't put his best engineers on, you know, maybe an Android that could be given away. And Microsoft could have had the operating system for phones, but they didn't. They focused on this lawsuit for Internet Explorer. So maybe Google and Facebook and Amazon, they're being sued. Maybe they're going to be distracted and someone's going to pass them up on AI. I don't know. But it's, let's look at some more things that we have here. Okay, so we have the opposite side. And this Rob Arnott said that people could lose confidence in the AI narrative. So they could lose confidence in all these themes, and if that's true, then that's not going to be good for next year. And the coming hard landing, okay, so expensive growth stocks it's going to cost more to fund them based on interest rates. So based on that, a lot of the stocks that are trading on a high PE that need to borrow money, they're not going to do as good. That's what he said there. All right, so that was a good excursion. Okay, so I wanted to show you the chart of Apple. I follow this, you know, pretty well. We marked this the day that it went out of that range. I'm hoping the S&P doesn't follow this. Right now, the S&P is stopped, like right at its trend line. But Apple went through its trend line. You can see it started as lower highs, lower lows. And the interesting thing about Apple is it hasn't increased its revenue in the past couple of years. It's been flat. So it's basically not trading based on earnings. It's trading on just appreciation of the stock. Its value hasn't increased. Its fair value. So let me see. Let's look at, it's only growing at like 9% year over year. That's what its estimates are, so it shouldn't be, it's 3 times overvalued right now. So it's oversold, and it's towards the bottom end of its channel. So let's hope it breaks out of this. It could be going in a sideways channel, I don't know, like a sideways movement. But for now, we're still stuck in this lower highs, lower lows for Apple. All right, let's look at some of the things that are going on in the stock market now. Okay, we have Nike is one of the highest performing stocks. They had that good earnings report. And let me see, what else is going up? We have some dividend paying stocks, and we have some drug stocks and some banks. No real theme there, though. Let's look at the ones going down the most. Okay, Carnival came out with earnings, and okay, we have an oil. Let's look at the price of oil. Oil, I think oil is down like 1% today. So all the oil stocks go down with the price of oil. Even though you have the best run oil companies, if the price of oil goes down, those stocks will go down with it. So we'll wait for that to pop up. So yeah, oil's down like 1% today. So all the oil stocks, you see, and we have earnings came out for these cruise line stocks. So they're basically in debt in a major way because of the pandemic. So it's going to be real hard. These are the kind of stocks that are going to be affected whenever interest rates go up more, because they have to borrow money. They had to borrow money in the pandemic to survive when there's no passengers, and now they're still paying for that. And the longer it goes, the higher interest rates go, the more these companies have to pay more for continuous operations. So all these are travel-oriented stocks. We have Hilton Worldwide, we have oil, and we have Norwegian cruise line companies. All right. And let's look at what the stock market's doing right now. What's taking so long? My internet's... for some reason, it's taking a long time to get these. Okay, so we're turning down the stock market right now. Okay, so we had the good news about the inflation, and that usually is good for the stock market. But we do have that situation where the Fed, the United States is probably going to shut down. If they shut down, then that's less money for companies, less money for the economy. People aren't going to be spending money because they're not going to give the handouts. They shut the money down. I mean, the government down. Let's look at some of the market movers. I'll try to get that. I wonder why this. Okay, let's look at some of the sectors that are going up and down today. We see the energy is down the most because of the price of oil. We see gold miners. Wonder why this is going. Okay, my internet's not working here for some reason. Okay, we'll have to go on a. We can't do the active websites now. I mean, active stocks. So we'll go back to looking at some of our news articles here. Okay, this is we have 5 minutes here left. What I'll do is I'll review how we determine a growth stock for buy and hold. Okay, we're looking right now at United Health. This is taken a while ago, but we're looking for stocks with low total debt, return on equity greater than 12, profit margin greater than 12, market cap of greater than 50 billion because bigger stocks have more reliability. The forward PE, we like to see it's low compared to its growth rate. So if its growth rate is greater than, we like to have growth rate greater than or equal to 10 and a PEG ratio around 1. And if it has a PEG ratio greater than 1, it has to have consistency and more reliability. And the higher the reliability of the earnings, the higher you pay for a PEG ratio. So whenever I do my screens for this group, I always go put these into the stock screener at Fidelity, and it gives us, all the stocks to look at. But Warren Buffett likes to have stocks that are durable in earnings, stocks that in 20 years, you're still going to have a demand for the product. And you see, it has good management. Those are intangibles. It's really hard to know that. And a lot of times you can confirm this whenever, a good investor like Warren Buffett has the same stock that you're holding or looking into. We like the earnings to go up in a straight line. This is a chart from E-Trade. It's the earnings over the price of the stock chart. And whenever you look at the earnings year over year, you divide 1 year by the other, and you get the growth rate. That basically, if you divide 22 by 24, you get a growth rate of 10%. And you do that for every year, and that'll tell you how much basically the stock's going to grow over time if this continues to go up to be correct. Okay, and whenever we look at Yahoo Finance, we look at the market cap, we look at the forward PE, the PE, the PEG ratio, and the profit margin, and the return on equity. And we like to have a return on equity greater than 15, and we'd like to see a total debt comparable to the market cap. Has to be a very low amount compared to the market cap. If it's close to the market cap and it's not a bank, then it's under a lot of problems when interest rates go up. And we like to see a dividend too. When a dividend is that adds to the total return of a stock. Right, and the last thing I wanted to say here is we had a downturn last year, and a lot of times the downturns are very small compared to the good times in the stock market. So right, like last year we had a 30% down market in the tech stocks, and this year they went up 30%. The good times are usually better than the bad times, and Charlie Munger said it's part of being a adult investor to be able to hold your stocks during the bad times, because you won't be able to get your big returns if you sell off, or if you're afraid to lose a little money whenever you're thinking of the long term.
So I think this is a deceptive example of data presentation.
Oh, really?
So if one of those red lines goes down 90%, that is, you have to go up, how much is it? You have to go up, if you go down 90%, you have to go up 10 times to get back, right? That's
absolutely right.
So if you have a red line that goes down 90, you need a green line that goes up 1,000 in that graph. I think that's a deceptive presentation of data.
Right. Let's take an example here. Let's take, if you started last year with $1 million, you lost 30%, you're going to have 700,000, right? So if you started this year with 700,000, you made 30%, right? Then you end up with something like 895,000, right? Does that make sense?
910,000, 30%.
Oh, yeah,
700 is 210.
Yeah, that's right. So that's an example of what you're saying. It's kind of, it's not what it looks. If you have to make a lot more, if you lose 30%, you got to make a lot more back to get back to your million, right? In this example.
Yeah. So like if you're at $1 million, you go down 50%, which then you're at 500,000. If you go up 50%, you're only at 750, right?
Right. Right.
And so that's why I think that this graph it really downplays how bad going down is, right?
Yeah, you're right.
That goes back to Warren Buffett says, the first rule is you don't lose money. That's why people tend to be conservative, and being too conservative can be very costly. But I do not like this presentation.
Yeah, right. You're right with that. But yeah, so you have to, and it's also if you decide to sell during the downturn, that makes it even worse, because then it starts going up, and then you buy back, and then if you have to make like 100% to get back to your $1 million, if you sell a portion of that as it's going down. So that's why you have to seriously know you're going to be committing to something for a while, and that's part of being an adult investor.
Yeah.
See, I guess this isn't that great of a chart.
Yeah. Well, so I think that the idea is correct in some sense, but I would. It doesn't feel like this when you're down like that, right?
Yeah, you're right.
And the gains, the percentage gains, once you start getting over 100% gains, right, it gets weird. So
Yeah, right. So let me see. Okay, so far this year and last year, we've been amazingly low volatility in the stock market. Usually there's like a 5%, 10% correction regularly, and we've been going up. If we look at our stock market, our S&P, we've been pretty much going up regularly without a big correction for a long time. We're right at this cutting edge at the bottom of this channel, where if we break through this like we did with Apple, every stock's going to follow that basically. I don't know, but I'm going the way I'm approaching investing is I'm trying to get as much as I can to meeting each of these requirements and everything I'm buying and holding, and over time, those kind of stocks are going to return 10%, a year. If you keep these kind of standards and watch the growth rate and does it make sense? Does the product make sense? Is it going to be around in 10 years and all that? So that's the way I'm doing it, and I'm hoping it works out. I think one mistake I'm making is I'm just buying and holding and not selling any, and I probably should start diversifying. That's why I'm looking into these bonds a little more. I don't know anything about bonds, but I guess you have to start diversifying after a while just so you don't have all your eggs in one basket. I think I've exceeded my time limit. Thank you very much, everyone, for attending. I hope you had a good time, and I'll see you next time.
thank you.
Thank you.
Thank you, Greg.